Hey guys, this is Lisa Church. I've written several blog posts on how the IRS collection works and the different options available to you, such as installment agreements and offers in compromise. But there's one option of which you may not be aware, and that is uncollectible status. The focus of my practice in Severn, Maryland is to help taxpayers get in compliance with their IRS and state tax filings and to represent them before the IRS and the states with their tax collection issues. I work with individuals as well as business owners, and a lot of my clients are real estate investors. So, what is uncollectible status, or currently not collectible, or CNC as it's sometimes called? If a taxpayer has no available equity and assets that can be sold or liquidated, such as a home or a retirement account, and the taxpayer doesn't have enough income to cover their IRS allowable expenses, then the taxpayer is deemed to be uncollectible. Keep in mind that I said IRS allowable expenses and not actual expenses. There's a list published every year by the IRS that details the amounts to use for food, clothing, housing, vehicle ownership and operating costs, out-of-pocket medical, and so on. While there are some actual expenses that can be used, such as for health insurance, these published national standards exist for most categories. So what happens if a taxpayer obtains uncollectible status? Basically, nothing. The taxpayer's accounts will be coded so that the IRS takes no levy action against them, and the taxpayer won't be required to make any payments at the present time. The IRS will also not take enforcement action against either the taxpayer's assets or their income. They may still place a lien on the taxpayer's assets to protect their interest, but the assets won't be seized or levied. We've talked about what uncollectible status is and what happens if a taxpayer gets it, but what will it not do for you? Well, it doesn't actually resolve your outstanding tax issue. The IRS can revisit the case at any time and usually does so at least annually to see if the taxpayer's financial situation and their ability to pay has changed. As a result, there isn't much peace of mind that comes with having uncollectible status, or at least not for a long stretch of time. So if it isn't a long-term solution, and if you have to keep justifying your uncollectible status, then why in the world would you want it? One of the best things that happens when you're considered uncollectible is that the 10-year collection statute continues to run. The IRS has 10 years to collect a tax debt from you. There's a whole lot more detail that goes into determining the collection statute expiration date, or the CSED date, but here's a simple scenario. If you filed your 2008 tax return in 2009, then the IRS would have until 2019 to collect the tax due on your 2008 return. If you came to me today for help with this tax debt because the IRS was threatening to levy your bank account and your wages, one of the first things that I would do is to determine your CSED date. Getting you into uncollectible status for the few remaining months left on your collection statute would be a great solution for you. Another reason that uncollectible status is a good place for some taxpayers to be is that it gives them time to get compliant so that they can make an offer in compromise or request an installment agreement. Before either of these collection alternatives can be requested, a taxpayer has to be in filing compliance by filing their back tax returns, which is generally 6 years of returns. They also have to be in payment compliance by paying their current year's income taxes due, either by withholdings from their paycheck if they're employed, or by making estimated income tax payments if they're self-employed. Taxpayers can use the time they're deemed uncollectible to get their unfiled tax returns filed and to get current with this year's tax payments. Or they can at least buy their time until the beginning of next year when they can start fresh with a new year when they can be current in their estimated tax payments. I'll get more into the dissipated asset issue in a future blog, but this is basically where the taxpayer used an asset that they owned to pay something other than their IRS debt. For example, cashing out their IRA to pay off their credit card debt. The IRS rationale is that they should have received the money from the IRA when it was sold, so that amount will be required to be added to any offer in compromise for the next 3 years. There are so many ins and outs and different things to consider when trying to determine the best way for a taxpayer to proceed in settling their tax debt. My goal is to help taxpayers navigate this confusing and overwhelming situation, whether it's with the IRS or a state tax collection issue. I've given you my contact information on this last slide and would be more than happy to help you with your tax issue. Just call or email me to make an appointment so that you can stop worrying about your tax issues and start doing something about them. And that will give you peace of mind. Stay safe, and I'll be back with more tax tips for you soon.